you basically said everybody's talking about how hopefully rates are going to come down now that they're approaching five. And you're saying, hey, that's not going to happen in the short term. And in fact, midterm, longer term, we might be nostalgic for 5%.
Exactly. Everybody over the weekend is running around with their hair on fire. Oh my God, look at rates. They're up. They're going to kill everything. These 5% rates, get me a paper bag to breathe through because we have 5% rates. And what I'm trying to argue is 5% isn't a problem. That's really what we should be at right now, I think. If these deficits are going to really kick in and cause problems, then rates are going to go much higher than this.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. The Game of Thrones Special Tariff Edition continues at its wild, unpredictable, and ever-changing pace. The latest development as of this recording has the US placing a pause on its recently announced 50% tariffs on the EU until July 9th. So, as we now have a little more clarity and data to look at since Trump's Liberation Day, what conclusions can we start drawing about the implications of these tariffs? Are they strengthening or weakening America's hand? Are they inflationary? Are US consumers better or worse off on net? For insights, we've got the good fortune today to welcome back to the program Jim Bianco, President and Macro Strategist at Bianco Research. Jim, thanks so much for joining us today, and happy Memorial Day.
Happy Memorial Day to you too.
Thank you. Well, look, again, I really appreciate you making the time on this important national holiday. We'll get you talking back, hanging out with your family, hopefully quite soon. But a lot to talk about, and you've been really busy on X recently, Jim, with a lot of, I think, kind of seminal points that I want to try to walk through here. Real quick before we get to them, and we'll get to tariffs in just a second, but just at a high level, how do you assess the state of the economy and markets today?
Uncertain, and we're trying to figure out what all of this is going to mean. Let me explain that. The natural state for an economy, a capitalist economy like the U.S., is to grow. It could grow slow, it could grow fast, but it grows. Now, about 10% of the years since World War II, we've had a recession. What causes a recession? Usually, it's an exogenous shock that comes across and changes everything. People stop doing economic activity, they stop buying things, and the economy contracts. I've referred to this as, the economy being murdered. The big question right now is, are these tariffs murdering the economy? And we kind of go back and forth on this idea that they're murdering the economy. We being the bigger picture of everybody, right? That they are, they aren't. If they stick around, they will. If he gives a pause, they won't. And that's going to be the big question. I had been arguing that I've been kind of giving an answer that I don't like, but it's the best one I could come up with, that I was 50-50 on a recession, but within 90 days, I'll either be at 80% or 20. And right now, I think I'm moving more towards the 20%, that we're not going to have that recession. We're not going to have that contraction in the economy. But what we are going to have, what I'm worried about, is higher prices and higher inflation. And that's going to matter because as I read Wall Street and as I read everybody is, okay, inflation's dead. Let's spend all this time talking about employment. Let's talk about about what the economy's doing. Let's talk about all these other things and whether or not they're going to get the Fed to cut rates. And the answer is none of that matters if we have price increases. And the Fed is not going to move at all. And interest rates are going to stay up if we have that inflation.
Okay, and I know that interest rates are something that you're looking at really closely right now. So let's just roll up our sleeves and dig into this. So I guess one thing I want to make sure that people heard that you just mentioned there is you don't think the Fed's coming to the rescue anytime soon here, right? So I think the market still expects a couple of rate cuts this year and then a few next year. You're going to take the under on that because you think you say inflation's going to be higher. I'm assuming that's largely due to the tariffs. And if true, let me just ask you this. Um, you know, One can argue that tariffs are a price shock, right? It's a one-time price increase, and then there's not necessarily an inflationary impulse after that. How are you looking at tariffs? As a one-time shock, or is there an argument to be made that they would be a sustaining inflationary impulse?
It depends, but I think at a minimum, it's a one-time price shock is what you're going to get out of it. And then it depends on what its impact on the economy is going to be. So what you're looking at here, the overlay I've been using, let me talk about the markets and then how tariffs work into this. The overlay I'm using on this is 2022. In the first quarter of 2022, the economy contracted. Actually, what we learned in 2022 was we actually had negative GDP in the second quarter too, which a year later was revised to slightly positive. But for most of 22, we thought the first and second quarters were consecutive negative quarters. And it was a big
technical recession, right?
A technical recession. It was a big discussion about a technical recession. What was the Fed doing during that period? They were raising rates 75 basis points a meeting because the march to 9% inflation, even though we were saying it was transitory, it was all because of the supply, it would come back down, didn't stop the Fed from raising rates. I think the same thing's going to happen now. Maybe it is one time. Maybe it is a step function higher and then it levels off. You're right. The Fed's not going to cut rates at all. And as a matter of fact, I think the market is getting that because as of Friday, the Fed fund futures are saying less than a 10% chance the Fed's going to raise rates in June, about a 25% chance they're going to raise rates in July at their July meeting, and their September 17th meeting went under 50% on Friday. So now the market is pricing in the next rate cut October 29th. And that one is only in the mid 50s anyway. So that one could disappear too. So we're not far away from saying, you're right, this is bad. Don't worry, in 9 months, the Fed will cut rates one time. Well, the argument here is that they're not going to cut rates because it's about prices. And prices is what it's about. Now, to the idea that it's a one-time step function, well, we increase tariffs, prices go up, the economy doesn't have a recession, everything's okay. Trump will do it again. And he'll do it again and he'll do it again. The only time he's going to stop doing rate or increasing tariffs is if there's a bad reaction to it. So we would have to argue that there was such a bad reaction that we would call him off. And if that bad reaction is a weakening economy, higher unemployment, well, that ain't showing up yet right now. And it would also have to come with no price increase. So I think that a lot of people are not in this idea that it is what I'm trying to argue here is the most important thing is prices. And the reason that they're going up, prices being inflation, and the reason they're going up matters more than whether or not the economy is having a recession and unemployment's going up or retail sales are weakening. By the way, none of that's really happening right now, but the fear is it will. Then those are of secondary importance, but the way it's being described is the other way around, is that the impact on the economy matters more, and that's what the Fed should be responding to. Just listen to all the questions at the FOMC meeting, what Powell took during the presser. Right. Every question was, why aren't you cutting rates? The economy's going to go bad. And he was trying to say, but we're worried about prices. Who cares about prices? Cut rates, the economy's going to go bad. And Powell was trying to say, I care about prices. And I think he's right to care about prices. And that's why I think I'm taking the under on all these rate cuts.
Okay. Let me just ask this question, make sure I fully understand your logic here. So you could say the Fed doesn't want to cut because if it cuts, it will, potentially that will put some pricing pressure under prices as these tariffs are also raising prices. But one could argue if it's a one-time price shock, if the Fed were to think it's a one-time price shock, the Fed would just say, look, I don't have any control over that. Like monetary policy, that's separate from monetary policy. And yeah, prices will re-rate once, but then that's it. And maybe that puts more pressure on the consumer. So maybe we should start cutting just to help the economy as the consumer is getting weighted down by this one-time price shock. Is there logic there, or am I just making
there's logic there, but here's the thing you got to keep in mind. If you go back to 22, 23, and 2022, the biggest issue was inflation. May of 22, President Biden famously had his one and only meeting with Jay Powell, where he literally pointed to him sitting on the couch and said, America, that's the guy who's going to fix the inflation problem. By 24, the inflation rate went, last year, the election year, the inflation went from 9% to 3%. And when you asked everybody in the polls, what is the single biggest economic issue facing the country? They said inflation.
Right.
And the administration kept trying to tell you, yeah, but it was 9 and went to 3. It's no longer a problem. Now, why did we keep saying inflation was a problem? Because we completely underestimate how devastating inflation is, especially to the bottom half of income that doesn't own a home, doesn't own a portfolio, is reliant on their wages, their raise to be greater than the inflation rate. Because you and me and everybody listening to this, if inflation rate goes up, we have the ability to pay those higher prices. They don't. They have to make choices that nobody wants to have to make. You have to take something else out of the grocery basket if you want to put this into the grocery basket because we only have so much money. And so that's really why inflation is such a problem. Now, if we get a one-time step function up in inflation, and the Fed's reaction is, well, unemployment might be bad, so we'll cut rates. We'll make it easy for people to pay that higher price. You're subsidizing that higher inflation. Now, let me give you another statistic. National Association of Retail, NAR, came out and said that 50% of the retail sales in the country is now done by the top 10% of income. And that's the most concentrated it's ever been. So
Sorry, 50% by the top 10%?
Yeah, half
Okay.
the stuff that's bought at stores in the United States is done by the top 10% of income, the most concentrated it's ever been. Let's cut rates and make it easy for them to hold those prices up. And then we have to explain to the bottom half of 50% why they can't afford anything. That's the mistake you make by cutting rates. Let's subsidize these higher prices for rich people. But, so then we put poor people behind the 8 ball. Paul was right in 22 when he gave his where there will be pain speech in August of 22, where he said, look, we can't let prices go up.
Right.
And if you rich people have to take pain, do your patriotic duty and take it, because we can't let these prices go up. We can't subsidize these higher prices. That's why I don't think they could be looking past even a one-time step function, because the public will be so irate over what was happening to them. That's the bottom half of income. And so that's why you don't want to go there in the first place.
So I totally get that logic. Let me just ask this question. I think if somebody from the Trump administration were here, they would say people might be angry if prices go up some, but they'll be even angrier if they lose their job and they have no income to pay for what they need. And their argument would be that's why the Fed should be cutting now, because yes, tariffs are going to put some pressure on the economy. We need some relief coming to make sure that corporations don't resort to big layoffs.
I would disagree that that's what the Trump administration would say, but I think they would arrive at the same conclusion that you did. I think what the Trump administration is saying, as Trump says, is look, there is no inflation. There is no reason for rates to be at these levels. You can cut rates and bring them down, is what they're doing. Now, at the other time, what Trump has been saying is there won't be any retail impact on tariffs, because he's been screaming that the Chinese will eat the tariffs. He's screamed at Walmart, that famous tweet he put out a week before we recorded where he wrote in all caps, eat the tariffs. Hey,
Yeah.
Walmart, you make a lot of money. Why don't you just eat the tariffs?
Yeah.
Other people have been talking about that retailers are going to raise prices globally. So we'll raise prices, on the Europeans and on the Canadians and on our stores in Asia to offset the increase of tariffs in the United States, so that we don't see the impact of it. That's questionable whether or not that happens in the first place. But that's what their argument is that those tariffs will be offset by other sources, not just borne by the American consumer. And you're right. He is trying to bring back, jobs into the United States. He is trying to bring back income to the United States. So let me take a step back here and let me say something nice about tariffs. I get what, this was Trump 1, this is Trump 2. I get what he's trying to do, and I think it's the right thing. What he's trying to do, I don't know if this is the right prescription. In other words, the amount of debt, the deficit, what the trade deficit has done to us in globalization. Look, we all benefited from globalization. I benefited, you benefited, everybody benefited from globalization. And I am not against globalization. But
Yeah,
what
sorry to
we are,
interrupt, but just to
yeah,
anticipate the screams of some of the viewers, the upper echelons, the top half of America benefited from globalization. There was a lot that didn't. Yeah,
that's exactly where I was going to go.
yeah,
What we've learned is there was a price to globalization. It was not a cost-free win-win situation. And the price of globalization was gutting a lot of manufacturing, heavy industry types of jobs. Now, why are these jobs important? If you 65% of the American public does not have a college degree. If you're looking to make a decent income without a college degree, it's usually working with your hands. It's manufacturing, it's construction, it's heavy industry. And those are a lot of the jobs that we gutted and sent overseas. Now, other people are going to be screaming at me, no, that was technology that pushed those jobs overseas. Or that was technology that automated away a lot of those jobs. And that might be correct. That technology was about to automate those jobs away. Just look at any image of a auto assembly line in Detroit where it's all a bunch of robot arms putting together the cars. It's no longer employees putting together the cars. That's
right.
true.
But that's past 20 plus 20 years to sooner. You're right. Back in the 90s to wherever, that was all cheap labor sucking those jobs away.
But I would also argue that China entering the WTO in 2000 accelerated that process. So
Agreed.
there was a natural attrition coming that got accelerated because of China.
Yep.
And so it came faster than everybody thought it was or naturally would have. And that's where the price was. So Trump is right. Look, this group or segment of the population paid a price. We need to do something to help this segment of the population. And no, it's not worker wage training or give them subsidies. We've tried all that. It doesn't work. He wants to, this gets back to what I thought was the winning formula for his 16 campaign, right? When Barack Obama famously said, was he going to wave a wand and make those jobs come back? And a lot of people that heard Obama say that and said, look, what Trump is at least trying, you've given up on even
Right.
trying. I will go with the guy who's at least going to try. And so that's why I said what he's identified is correct, that there's a problem, especially among the working class here, because we've gutted their jobs. Is the solution that he is proposing the right solution? And that leads off with tariffs and a lot of other things. That we could argue maybe is incorrect. But what is the proper answer? Is the answer, because this is where, when I read the mainstream press and they say, look, the tariffs are wrong, the tariffs are going to destroy everything. Look, you might be right. But what you're implying is stop. Go back to $7 trillion deficits or budgets, $2 trillion deficits. Just keep borrowing. Just go back to the status quo that we used to have and everything will be okay. We can't go back that way. So if you don't like this radical policy of all these tariffs and jerking around with tariffs and stuff, then give me another radical policy, because we're not going backwards. We're only going forwards. And maybe we took the left-hand turn on the road and you're saying we should take the right-hand turn on the road or vice versa. But, we're not putting the car in reverse and we're not going back the other way.
Okay. So one of the points we're getting to here in this conversation, folks, is going to be about bond yields. So stick with us, but we got a little bit
Yeah.
of more wood to chop between now and then.
Because
So,
this directly affects bond yields.
well, absolutely. So we're going to get there. So, great point, which is what I hear you saying is hey, there's a lot of logic behind these policies. The execution is where the debate is, right? It's just the right way to do it. And let me ask you this on tariffs. So, tariffs, it's I don't want to say it's a trickle down, but it's a chain, right? Where the importer pays the tariff, as I understand it, and then the the domestic company that is buying from the importer then pays 100% or some lesser percentage of that tariff, and then passes 100% of that or some percentage less of that onto the end user. Meaning the end user might not end up paying 100% of these tariffs, right? We don't know yet. We're going to still figure that out. But tariffs also, they can change consumer behavior, right? So in other words, domestically produced products are not getting tariffed, right? And that's one of the big carrots that Trump is offering here, right? Is hey, you build your factory here, you make it with American workers, you're not going to have to pay a tariff, right? So we might see some shift of consumers going from buying imported products to domestic products, right? And not having to pay necessarily that much extra for it. Um, and we might see corporate America eat some material percent of these tariffs because profit margins are about the highest they've ever been, right? There's room for them to eat some of this stuff. I'm sure they'll pass on as much as they feel they can get away with, but they do have some room to absorb this. So I guess my question is do we have enough data at this early stage yet to know how these tariffs are going to play out in terms of what the actual end consumer is going to have to pay?
Yeah, so we've got some data. There's two sources. They're kind of the same thing. One of them is called Trueflation, and the other one's called Price Stats. Trueflation and Price Stats are these big data services that basically measure millions of web prices every day, and then they aggregate all of these prices into like a daily estimate of CPI, and they can break them down by various categories. As well too. The caveat I will give you with this data is it tends to be goods based, right? It's hard for me to go online and find the price for a plumber to fix my toilet or for a doctor, how much he's going to charge me.
Right.
That's usually negotiated face to face.
Face to face,
But
right. And most of the
yeah,
inflation pressure has been on the services side, right?
right. And so goods inflation tends to be lower. So what you want to look at with these measures is the rate of change, not necessarily the levels, because the levels are much lower. And the rate of change has been going up since about May 1st. I'll start with price stats. Price stats is broken down the pricing of products by origin. And the prices of products that originate out of China going straight up since May 1st. And Trueflation does more of an aggregate level. And since May 1st, they have said that CPI has increased by 0.7%. So that's a big increase in
That
less
is a
than a
big
month.
increase.
In less than a month. Now,
Well, and they were what? I think they were under two at one point.
yeah, no, they were at 1.3 at the beginning of the month, and now they're 2.1 is basically where they've gone in 25 days is where their numbers have gone straight up. Now, you're right. Based on what we said before, maybe it's going to step function and level off, but prices are going up. So there is some evidence that prices are being passed along. Remember that Trump's eat the tariffs comment to Walmart was Doug McMillon on their earnings call. He's the CEO of Walmart about 2 weeks ago saying, look, by the end of the May, we're going to start to have to raise prices.
Mhm.
And the last thing I'll point out that is showing up a little bit, and you asked about how much they can get away with to raise prices. The last thing I'll mention is what the price stats data is also showing is some evidence that all prices are going up. So what the Fed would refer to this as, and I think this is why what we're waiting for, gets to interest rates, is what they refer to as unanchored inflation. If you give me a reason to raise a price, do I use it to raise that excuse to raise every price?
Mhm.
And there is some evidence that might be happening. Look, we've got these tariffs, so we got to raise prices. Yeah, but you're raising prices on everything, is what you're doing. You're trying to get away with raising as many prices as you can, which we refer to as unanchored inflation. And that's what really worries the central bank, is that there's this inflation mindset that's setting in. Now, I'm not saying we have it, but there is some indications that that might be unfolding in the economy right now. And that's what I think we're starting to see in interest rates and in bond yields going up over 5%. And what we're seeing is a combination of two things. We're talking about prices now, that we have higher levels of inflation, and we've also started to see huge deficits, which we could talk about in a second.
I was literally just going to go there. Yeah.
Yeah, but I was just going to say, when you have higher levels of inflation, the bond market, because it's a fixed income security, is going to demand risk premiums. We call those real rates, right?
Yep.
I want my yield. If I think inflation is going to go up, I want interest rates or yields on my bonds to be above the inflation rate to compensate me for taking that risk. So we're seeing higher risk yields, or if you want to go wonky on it, they call it term premium, and that the term premium is starting to expand on interest rates, and that's pushing up yields. Now, the other thing that is pushing up yields, which I'll let you lead us with the question is also higher borrowing costs as well too, bigger deficits.
Okay, so well, we're all getting to borrowing costs, but I've heard you make an argument in the short term that because of tariffs and their potential inflationary impact, you don't see the Fed cutting rates, and that's putting, bond investors are saying, okay, you gotta pay me a bit more, right? And that's what's been pushing bond yields up in the near term. So you've said, look, don't expect rates to come down, this year
Mhm.
maybe, right? From reading some of your other stuff, it sounds like you're saying don't expect bond rates to come down in the mid to longer term either. And I'm wondering, is that more because of tariffs, or is that more because of uh, the fact that we're not getting fiscal spending under control, and now looking at the details of the big beautiful bill, as at least it's what's passed the House, we're seeing, oh yeah, no, the deficit's going to keep rising for a good while. We're going to be slapping a lot more debt here in the near term. I think you've been referring to this as the end of the beginning, if I'm not mistaken, in some of your recent writings. So, do you see us, going into this more secular period of continued higher deficits, and that's why the bond market is going to say, look, if that's where we're going, you're going to have to pay me?
Yeah, exactly. So, to give you the problem with the big beautiful bill and the problem with what we're seeing was Trump comes in, he says he's a fiscal hawk. He brings in Doge. Doge says they're going to cut $2 trillion of wasteful spending. Now, nobody believed 2 trillion. But what we're finding from the House bill is, and Elon has now left Doge and gone back to Tesla. And what we're finding from this bill is that there ain't going to be hardly any cuts of wasteful spending from the government. You can't tell me this government spending, that $7 trillion a year, we're still sending retirement forms down in a mine in Pennsylvania, that we can't find any places that we could cut more than a couple of $1 billion here or there. And then on top of that, we're not going to touch Medicare, we're not going to touch Social Security, we're not going to touch disability or any of those other third rail things. I think the market's looking around and going, between Doge and Trump and the Republican Congress, here's our best bet to try and rein in government spending. And we're not reining any of it in. And it's not going to get any better as we go forward from here. We're not going to elect another Congress that's going to do a better job than this Congress. Most likely, we're probably going to turn the House back
Right.
to Democrats, and it's going to be even harder to, rein in government spending in the future. So I think really what the market is saying is, if you're going to continue, let me put this number for everybody to understands. The budget deficit, the budget of the United States federal government is $7 trillion a year. We raise about five of that in taxes. So the other two we borrow. What we're looking at here is maybe that two becomes two and a half over the next couple of years. That's a lot of demand on the capital markets that the federal government is looking at doing. It wants to suck $2 to $2.5 trillion a year out of capital markets into bonds. There's an old saying in the bond market, I've often used it. There are no bad bonds. There's only bad prices.
Mhm.
Can the bond market get that $2.5 trillion? Yes, it will get it. How will it get it? It will take interest rates up so high that it'll make it such an attractive deal to put your money in government bonds. You'll willingly take it out of the stock market or anywhere else you have it to put it in the government bonds. Oh, I'm not going to do that at 5 or 6% yield. Don't say that, because we'll just keep going till we find that level where you're going to wind up putting your money into the bond market. Now, that's not going to happen immediately over time. I mean, immediately in the short period, but over time, this huge deficit is going to continue to push on yields going up and up. And why I started with the inflation argument is we're not at that extreme level now. We're at pretty normal levels. So I think that those rates are going to keep going higher from here.
So just restate that, if you will, because when we were talking before we turned the camera on, you basically said everybody's talking about how hopefully rates are going to come down now that they're approaching five. And you're saying, hey, that's not going to happen in the short term. And in fact, midterm, longer term, we might be nostalgic for 5%.
Exactly. What I was saying before we started talking was everybody's running around. We're recording on Monday, Memorial Day, And everybody over the weekend is running around with their hair on fire. Oh my God, look at rates. They're up. They're going to kill everything. These 5% rates, get me a paper bag to breathe through because we have 5% rates. And what I'm trying to argue is 5% isn't a problem. That's really what we should be at right now, I think, given the argument that we're in the kind of a 3-ish% world and you have real rates and bigger premiums in the market. This is about normal. That the Fed shouldn't cut rates because I think that the neutral funds rate is around 4 and we're at 4.25. So we're pretty close to neutral right now. But if these deficits are going to really kick in and cause problems, then rates are going to go much higher than this. And if they do go much higher than this, you're right. At some point in the future, people are going to say, I'm bullish on rates because we're at 5.5. We're going to go back to 5. Well, this is the level right now that we're hyperventilating about. And that in the future, this might actually look like a fairly normal interest rate because it is a fairly normal interest rate. The problem is we had this unusual period between 2010 and 2022 of zero interest rates and money printing. Sidney Homer and Richard Sala wrote a book called A History of Interest Rates, 5,000-year history of interest rates. There are records of interest rates back to 3000 BC in Babylonia. Yes, there are. And they wrote a 700-page book about it. Nowhere in that book is there anything about zero interest rates, negative interest rates, money printing. That was a new thing we invented between 2010 and 2022, negative interest rates with money printing and the like, not to be repeated again. And the problem we have is everybody thinks that was normal, not recognizing that was one of the most abnormal, especially in Europe with negative interest rates, in Japan with negative interest rates, was one of the most abnormal periods in 5,000-year history of interest rates. And we keep wondering, when is the Fed going to cut to zero and start money printing? And when are we going to see negative interest rates, all over the place again? And that's why we need to see, that's why everybody's still bullish on interest rates, because they think that that period was normal, not that that was the abnormal period in the recent history, that the current period is actually fairly close to normal.
All right. So, Jim, if, pretty much every active investor right now is normalized to a hyper low interest rate world, and we're now going back to 5% plus, what implications does that have?
Right. Not only every active investor, also the president of the United States too. That it is competition is really what the issue here is. And what I mean by competition is I've been using this argument that we're in the 4, 5, 6 markets. And what I mean by that is over the next several years, that cash will return you somewhere around 4%, a money market fund or a T-bill. Bonds, well, investment grade bonds right now are averaging about a 4.90 yield. That's all treasuries, corporates that are investment grade, mortgages that are investment grade, agencies that are investment grade. It's about $30 trillion worth of bonds. They're averaging about 4.90. Let's call that 5. And then stocks, given the high valuations that we have in stocks with rising interest rates, what should you expect stocks to return us over the next several years? Probably about 6%. So I've called this the 4, 5, 6 markets. Now, if I'm right, and the inflation rate's around 3-ish, that's not bad. That is not terrible type of investing environment. There's a real return in all of those assets. But two things. It's not the 20% that everybody's gotten comfortable with that we saw in 22 and 23 and 24 in the stock market. And other investment categories like cash and bonds are competitive with stocks. There is an alternative, the opposite of TINA. Because what a money market fund will give you is 4 with no risk, a $1 NAV every day. A bond fund will give you a little bit more, but last year was a bad year for the bond market. It returned positive 1%. And that was a bad year for the bond market. This year, we're talking about the bond market struggling and everybody hates bonds. They're up 1.5%. They're up more than the stock market is on a total return basis. But that's the thing about the bond market is it'll give you a little bit more than cash with a little bit more risk, but not a lot of downside. The stock market can give you 6%, but the problem there is it might be 20% one year, minus 10% the next year, and they kind of average out to a positive around 6. So that's really where I think we are with asset classes, is there is there is an alternative for the stock market right now, and it is in the other alternatives you would look to, cash and bonds. Last thought for you. That doesn't mean, I'm talking about 6% like at the index level, right? It doesn't mean that there won't be opportunities, whether you want to look for those opportunities in growth like AI, or healthcare, typically the growthy type of areas, or if you want to look for those in some kind of other thematic kind of idea, like maybe energy or industrials or consumer cyclicals or whatever you think might be a good. Financials have been beat up. Maybe they respond. Maybe in those you can get better than a 6% return. But if you're demanding 10, 12, 15% from the asset class, I don't think you're going to get that from the asset class anymore. You're going to have to take a thematic risk, buy stocks, buy a theme, and hope that you've got the right theme in order to get those kind of bigger gains.
Okay. And presumably, commit to that theme, like hold on to it for the long stretch it's going to take to determine whether it pays off or not.
Right. And usually what people will tell you is the best way to do the themes is you do 5 of them. 2 of them don't work, or 3 of them don't work out, and 2 of them do, and 2 of them do make you more than the 3 that didn't work out, and you wind up with a 10% return.
Right.
It's not just pick one. Oh, I got to go all in on AI. All right, that might be one, but there might be some others that you could also look at too, that in the broad scheme of it. So in other words, what I'm trying to argue here is active management might be making a return. We're
Right.
going to go back to the days of the stock picker again, something that we've gotten away from in all these years because the asset classes have gone up so much, and all these index funds with zero fees have been dominating the investment landscape.
Yeah. Well, when a rising tide, raises all boats, it's super easy to be a successful passive investor. So, Dave, you're echoing a lot of folks that have been on this channel for a good while, saying that we're switching from the era of passive now to the era of active. And your point there about diversification, I mean, that's just classic investing 101, right?
But none
Um,
of that was working until, I mean, the last couple of years, diversification meant losing money, right? You just wanted to be pressing the bet on the stock
on
market
the
and
Mag 7, yeah. Not even
yeah, and then the
stocks, just
Mag
Mag
7.
7.
Yeah, and we were screaming, Tina, there is no alternative. We were basically saying diversification is a waste of time, but now we're kind of going back to that.
Yeah. Funny, I've shown this on the channel a couple times, but there's been a meme going out on sort of like the TikTok social medias, which says, "Hey, this is the most valuable financial behavior you can adopt," and it shows somebody throwing Benjamin Graham's The Intelligent Investor in the trash.
Yes.
And that's from the old Tina era, right? And now I think that probably the new meme is going to be people desperately scrambling to pull it out of the trash.
Yeah, exactly. Because keep in mind that all investing is cyclical. I mean, if you hang around long enough, what was old will become new and will become old again. And so I think the mistake that everybody makes is that they think that investing is secular, is that here's a theme and it will be that theme forever and ever and ever. But think cyclically when you think about investing.
Okay. All right. Well, look, I am going to ask you for your market outlook as we wrap up. Before we get there, though, I got a couple other really interesting topics I want to try to get your thoughts on, and we're getting a little
Mhm.
tight on time, so we'll be focused here. Um, you wrote recently about how the downgrade of the U.S. national credit rating was just a blip in markets. They shrugged it off really quickly. And you said the bigger issue that explains that is that retail is now the dominant force in equities. Of lesser importance is what the whales, hedge funds, and other institutions are doing. So this is a real flip of the script. And I got a couple questions for you about that. Um, uh, One, how much of this retail dominance is due to intentional action on retail investors versus just the passive capital flows, the giant mindless robot that Mike Green talks about, that just is buying month after month because of retirement plans in corporate America? Um, so that's question number one. Question number two is just what does history tell us when retail is in the driver's seat? What happens?
Yeah. So on the first one, I think what's happened with retail is because of the advent of the low cost ETF and because of zero commissions and because of the internet, If you're a small retail investor, you have the capabilities of $1 billion hedge fund manager. What can he do that you can't do? And the answer is not much. You want to buy local market or current emerging market debt. There's an ETF for that. You want to buy equally weighted S&P 500. There's an ETF for that. Before you would have needed to have specialized traders and trading relationships in order to do those types of things, high-speed computers to, balance off buying equally weighted all 500 stocks and stuff. You could have done that. What about the cost? Well, the fees on these low-cost beta ETFs is practically nothing, and most of these online brokerage firms have zero commissions. Okay, well, how do I know about all this stuff? Well, the internet's out there, social media's out there. Half these billion-dollar managers are doing the same thing you're doing. They're reading X, waiting for the next idea like you are. So that's why I think we've seen the rise of the retail trader. They have the tools and they have the access that the billion-dollar hedge fund manager has. Now, what the billion-dollar hedge fund manager has over you is maybe he's more talented. That's why he's a billion-dollar hedge fund manager.
He's got a team of PhD quants.
And he's got a team. He doesn't rely on himself to find it, but he's got all these other people scouring the same sources you are. So he's got a power of 10 or 20 or 30 because he's got other people doing this for him and stuff. And that's what you're ultimately paying for. But what we're learning is that really what you're paying for? Because he can't really beat the S&P, or up until now, and I think he will. He couldn't beat the S&P anything more. So that's why I think we're seeing the rise of the retail trader, and that the retail trader is directing itself. Now the problem with the retail trader is it's not you hinted at the retail trader. How does this end? It always ends badly because retail tends to overdo it. I agree, they do. But what is it that they're overdoing? And that gets to who is the demographic of the retail trader? The demographic of the retail trader is a person that is younger and is looking at shorter terms. So they're buying levered funds, inverse funds, zero DTE options, 0 days to expiration options. Those are options that start trading in the morning that expire at the close that day. So they're very, very short term. So there is, as Mike, you mentioned Mike Green, there is a fair number of what in the markets parlance or they call allocators, people that will allocate money towards, themes like target date funds or index funds. And this is in my fund, in my portfolio, and it's just going to stay there for years. I'm not going to touch it no matter what. Those are allocators. What we're talking about, the rise of retail, is the traders. These are the people that are in and out of the market quickly, using leverage, using short-term options, trying to game the system for quick buck. And that is where I think we got to start to be worried that short-term trading is overdone. As you pointed out, what I was referring to was the morning that the Moody's downgraded the U.S., the stock market opened down 1.5% and closed that day up on the day, slightly up, but it got back the entire 1.5% loss. What JP Morgan said was that in the first 4 hours of trading, retail accounts plowed $4 billion into the stock market in 3 hours. And so, that is, as a group, they are a dominant force right now. And also, what may be new to causing them to be a group is there's a centralizing mechanism for retail, because retail is hundreds of thousands, if not millions of investors. And that centralizing mechanism is social media. So they're all kind of, getting into the echo chamber and all kind of doing the same thing. And they're all kind of screaming at each other. We got to buy the dip, buy the dip, buy the dip. And they all run in and buy the dip. Maybe 15 years ago, we still had millions of people that were doing this, but they weren't connected to each other in different ways. And they were all decentralized, doing different things. So as a group now, they are the dominant player in especially the equity market, because that's where they think that the fast money is. Crypto also is another place there. Where they're not the dominant player is in the other asset classes, like international, emerging, fixed income, alternatives, those types of things. That's still more of a professionally whale-driven market. Those are. But in equities, especially in Mag 7, especially at the index level, using leverage and using short-term options, it's retail all the way.
All right, Jim, so help me understand the interplay between these two retail cohorts. So we've got the active retail traders that you just mentioned there, and we have the passive capital flows from the giant mindless robot of, you know,
Allocators.
yeah. And what we've been hearing for years, and I get it, is that that's a massive amount of money that's coming into the market every month that is price insensitive, right? It has to buy at whatever the market is. Given the allocation ratios, a disproportionate amount of that goes into a small number of stocks, mostly the Mag 7, right? So they're having this kind of continued tailwind pushing them higher. We now have the active folks as well in that space. And we all know that stocks are priced at the margin. So a stock is worth whatever the highest bidder is willing to pay for it at that moment in time. So how do those two interplay with each other?
It's a good question. I think what you're seeing is on that allocation side, the people that have their 401ks, that they get the reform from HR and they check off, what percentage they want in certain funds, and it comes out of their paycheck every month. Those people are older, running into retirement, and I think that while they're the dominant force at the margin, I think they're kind of peaking and coming up. The younger cohort, the under 40 crowd, is the larger cohort of traders, crypto, and they're the pricing at the margin right now. What I think is going to happen here is I'll give you an anecdote from a podcast I was listening to in April. Woman was 72. She had to take her mandatory payout on her 401k because at 72, you have to take your payout if you don't take it at that age. And she was beside herself because she's 72. She knew she had her payout coming. Her portfolio was largely Apple, Nvidia, growth stocks, QQQ. She had lost a third of her money because of Liberation Day and was then forced to take a payout after she
Mm,
was down a third. And of course, the podcast person was trying to politely say to her, once you get to a couple of months before your payout, whatever you have, you have. And you have to maybe think about protecting it from going away as opposed to there's going to be one more moonshot
right.
6 hours before I have to withdraw my money. In other words, why weren't you in cash and in bonds? Is basically what the question was, because you put yourself into that position. And a lot of people like her, it never occurred to them that they thought that Nvidia was as safe as a T-bill, is basically where they are. I think over time, that's going to become a realization with the 4, 5, 6 markets that these aren't as safe as T-bills, and there's going to be a kind of a risk adjustment with a lot of them. And at the margin, the younger crowds are still going to be more speculative, as what we've seen with the leverage and with zero TTE. And by the way, I know we've talked about this in previous times I've been on with you. That's cultural. I mean, because these are the same people that are on DraftKings and FanDuel, and so this whole gambling mentality has many facets in our society today. It's not just the stock market. The stock market with leverage ETFs and zero DTE options is just a reflection of what we're doing in other parts of our life. It's not unique.
So let me build on top of that. So here's a concern I think a rational person could have. Um, that whole kind of gambling mentality, Dave, as we've talked about, I think is a function of largely two things. Um, uh, we have given the younger generations poorer prospects than the older generations had at the same time for capital formation. So they feel like they have to the only way I'm going to be able to afford a middle class lifestyle is to kind of get a winning lottery ticket, right? Get that
Hmm.
crypto that goes up or get that meme stock that explodes higher, right? So there's the belief that's gone into their minds. And we have flooded the system with a ton of liquidity, right? And they're used to that. And that has pushed asset prices up. It's created speculative bubbles, right? It's given them opportunities to play. So if we get into a point where the passive cohort, right, that starts peaking and beginning to tail off, right? So it's less of a headwind than it was. And of course, this is what Mike Green has always feared, right? Is you get to a point where the giant mindlet robot switches from growth to contraction, right? And you'll have all the
Right.
same issues in reverse. So if that starts happening and concurrent, we get some sort of true bear market, right? Where what does a bear market do, right? It just crushes people's confidence and sentiment to the point where they finally say, I've been burned enough, I'm just freaking out, right? So we take this highly speculative cohort, they start losing, they bet bigger, they lose more, they bet bigger, they lose more, and then they just leave in disgust. That could be a very dicey moment in markets where you have the cooling off of that massive pool of buyers and concurrently with the cooling off of the speculators.
Yeah, exactly. And I would also throw in real quick that, not only, buy the dip, the Fed bails us out, but the younger cohorts being on social media and online, right? Who are their influencers? People that are sipping champagne in private planes going, I did it with crypto. I did it with meme stocks. I did it with whatever, speculative idea. You
Yep.
can too, or they don't say you can too, but they imply, why aren't you like me in this plane, sipping champagne? So that's been kind of their motivation. And then that's why so many of them still cling to this idea from the 2010 to 2022 period. Yeah, but the Fed's job is to make me rich, right? Every time the market goes down, they'll just print money and throw it at it and force the market up. So I can't lose in this game. And that's really what we're going to have to deal with. Now, you're right, that's going to be a problem for the markets, but I'll go back to the old Ben Graham line. In the short term, the market is a voting machine. In the long term, it's a weighing machine. So we're talking about a lot of the voting that's going to go on, and it can create problems and issues in the short term. But in the long term, if the markets are weighing machines, that's where I come back to. I still think you'll get a 6% return with a lot of excitement out of these markets. You just won't like the excitement. Maybe you'll be happy with 5 in bonds with less volatility, or 4 in cash with
Right.
little to no volatility.
Your six might come with a negative 20% followed by a positive 27%, right? But
Exactly,
yeah.
exactly. And that's what we might be. Look what we're seeing right now, 25% last year, and here we are almost in June, and we're at zero for this month, or for this year already. The total return in the stock market is effectively zero as we're recording it late May right now. And so we're starting to see some of that happen right here. So I think that that's really the environment we're in. And it also comes back to the other thing I'll point out about markets too. The high valuation in the market. Is it bad to buy a highly valued market like the US stock market? No. It's just you're betting on a lot of things are going to go right. But if you've got a president who's identified as, that globalization has been bad, we've got big deficits, we've got to do this, we've got to do these, we've got to try and reorient and restructure the monetary order, starting with tariffs and jerking tariffs around all over the place. There's a reason to think that that's not a good environment to buy highly, richly valued companies in that environment. That's one of the reasons why I think the European stock market's doing so well, because I think a lot of investors are saying, why buy a 22 PE in the US when I can buy a 10 PE in Europe? I only need a few things to go right in Europe to make money. I need a lot of things to go right in the US to make money. And I was getting a lot of things going right until we got to this environment where we're trying to restructure everything. So I'll take the 10 PE. And that's why I think we're starting to see that shift. But you're right. This is going to be a volatile period. It doesn't mean it's going to be a disastrous period. It will look disastrous like early April did for a while, but then it recovers. But at the end of the day, you look around and you go, but I'm not really making any money. I just recovered some of the losses.
Yeah, and that's if you didn't panic sell out at a low. All
Mhm.
right, so you're taking it to where I wanted to end it, which is the so what, right? The viewers of this channel, we've definitely do have some professional investors, but it's largely regular retail investors who are just trying to make their way and prudently grow their wealth, but not get destroyed, right, by some of these forces we're talking about. So as you look through the lens there at Bianco Research, you know, do you have any general counsel for how the average investor should look at navigating this market? And you've probably given us some breadcrumbs already, but are there certain
Yeah.
assets that you like and certain ones that you would recommend folks stay away from given all these dynamics?
Yeah. So the so what is it's all about expectations, right? 4, 5, 6. Those are decent expectations. Those are not terrible markets. And I think that we need to start thinking about how to structure yourselves in that 4, 5, or 6. How much risk do you want to take? If you want to take, risk, you can go beyond the 6 and look at the themes. I don't know how to do themes, you might say. What there is fortunately happening in the ETF market is a new class of active managers are now listing ETFs. Kathy Wood being kind of the OG in that era space, right? So that you can go and you could say, I don't know where I should be investing to make these, excess returns, but there are professional managers that now have ETFs. You could buy their ETF. That's a way to look for that. If you're thinking about it on the other side of the equation, I don't want to be like that person who was 72 and wind up getting wiped out right before I'm forced to take my drawdown. Then you might want to start looking at allocating more towards bonds and cash, because one of the things about rates going up is I should mention there's another chart going around that the rolling 10-year return on bonds is like the worst it's been in 100 years. Yeah, that's true because of what happened between 2020 and 2023. To get rates from 0 to 5% meant that bond investors took enormous pain. That pain's over. Now bond yields have a big coupon, 5%. That is going to cushion you a lot in environments of rising rates. Like I said, a bad year in bonds might be 1 or 2% gain. A good year in bonds might be 8 or 10% gain, averaging about 5. So maybe that's somewhere that you can go is into the bond market. Cash can return you around 4. A money market fund or T-bills can return you around 4. But the great thing about cash is there's no price volatility in that. $1 NAV every day in your money market fund is what you're looking at too. Lastly, I'll point out a thing about bear markets. I've often called the bear market time, not price, because doesn't the market always come back? That's kind of the degen mentality of the 35-year-old that's playing in levered ETFs and stuff like that. Doesn't the market always come back and make new highs? And the answer is yeah, it has. But how long does it take? Now, in 2020, it took 5 months. Here we are now. We're in the 5th month now. We're sort of kind of close to the all-time high. But in 2000, it took 13 years.
Right.
In 1966, it took 18 years. So really the question is, will the market come back? Yeah. But if you're 70 years old and you're wondering, yeah, the market come back? What if I told you it took 13 years? Well, I don't want to wait till I'm 83 to get back to the same net worth that I'm at today. But if you're 35 years old and I told you it took 13 years, you'd probably say, great, I could dollar cost average for the next 11 years at a much lower price, ready for the next 20-year run. So you've got to kind of put it into that kind of mentality that a bear market is time, not price. I'm not so much worried about how low the market's going to go as to how long is it going to take before it starts to make new all-time highs. And I'm of the opinion that this environment, it's going to take a while. Now, we might marginally make a new all-time high by 1% or something like that. But to get a real serious move up, we have to resolve some of these issues like tariffs, like the deficit, like a lot of other things, because without it, we're going to have such a big draw on financial markets. You got to fund the bond market first. Those markets are going to have a hard time moving forward. So I'm not worried they're going to get crushed. I'm just worried that if you're expecting 20% because that's what you've always got, you're not going to get it. So it's really about expectations is what it's about.
All right. You had so much in there, Jim, too, that underscores my continued refrain on this channel about why most people should be working with a good financial advisor, right? Who can be providing the types of counsel and advice like to that 70-year-old about, okay, here's what kind of allocation makes sense given where you are in your life cycle and your goals are and when your distributions kick in and all that type of stuff. So it's not even just necessarily picking the next assets for your portfolio, but it's structuring, the exit plan and all that type of stuff. So, all right, well, look, wonderful as always, Jim. You talked a few minutes ago about actively managed ETFs. And last time we talked, we were reviewing the performance to date of your firm's first ETF, and I now believe it's been out for over a year. So what's the update there?
Yeah, so we manage an actively managed index called the Bianco Research Total Return Index. It is at biancoadvisors.com. It's the 5 and the 456. It's a total return fixed income index. There is an ETF that tracks us, WTBN. Wisdom Tree is our partner. Wisdom Tree, Bianco, Nancy. It's been out for a year and a half right now. Why is it? Why did we pick that? Because that's kind of where I feel my strengths are. Is I originally was a bond guy that became a macro guy who still loves the bond market. And so 18 months into this process, our relative return has been pretty good. You could look up WTBN on Morningstar or anything else, and you'll see that relative to the other peer groups that we're in, I'm very happy with our results. Now, absolute, the bond market, has been a bit of a struggle. We're up around 5.5% in the last 18 months. And that's, I think because 2024 was largely a bad year, I think we're probably due for a better year there. But that's a way to do it. So the last thing I'll mention about bonds, and this is kind of part of what we talk a lot about, you might say, but no one can beat an index, right? Except maybe if we're going into this period. But historically, that's true in stocks, right? 80% of active managers can't beat the index. Maybe that's going to change if we go to a 6% environment. But historically, in bonds, about 50% of the managers can beat an index. And one of the bigger areas in the fixed income market is active managed ETFs. We have one through our index structure. Like I said, think of me as like the president or the head of the S&P Index Committee, and SPY tracks us. I run our index, and WTBN tracks us. But lots of other big firms from BlackRock to PIMCO to State Street, and the like, even Vanguard are bringing out actively managed fixed income ETFs. My personal opinion is if you want to invest in fixed income, you'd probably be better off to use a professional manager. And like I said, retail is big into equities, but when it comes to anything else, fixed income, international, emerging alternatives, I think that's still those are still the domains of the professional manager, and we're offering one of those alternatives with the fixed income space with WTBN.
All right, great. All right, well, look, congrats on your relative performance in the industry. When I edit this, I'll put up the ticker to WTBN there so folks know where to go if they want to check out the ETF directly. For folks that would like to follow you and your work in between now and the next time you appear on this channel, Jim, where should they go?
Well, we have two businesses, right? The ETF, but the other business, our main business is a research business, biancoresearch.com. You can take a look there. Most of that stuff's behind the paywall, but you can request a free trial if you want to look behind the paywall. But to augment that, I try to stay active on social media. Bianco Research on X, Twitter, and we have a YouTube channel too. And I'm active under my name, Jim Bianco, on LinkedIn. Those are the three social media sites you can find what we're talking about.
All right, fantastic. Well, look, folks, if you've enjoyed this interview with Jim, please let him know that by hitting the like button, then clicking on the subscribe button below, as well as that little bell icon right next to it. As I mentioned earlier, if you have a demonstrated successful track record of successfully investing your portfolio in environments that have potentially persistent inflation, a fair amount of volatility, and some of the other dynamics that Jim mentioned here, great. Continue doing what you're doing. I think if most of the people watching this video are honest with themselves, they don't fit those criteria. And so I highly recommend most of those people seek the guidance of a good professional financial advisor who does meet those criteria, who can help you, basically come up with an appropriate portfolio strategy for your financial portfolio, and then actually help you execute it. If you've got a good one who's doing that already for you, great, stick with them. If not, consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses. To do that, just fill out the short form at thoughtfulmoney.com. Only takes you a couple of seconds. Reminder, these consultations are totally free. You will get bespoke, personalized guidance from them on your own unique situation. You can do without whatever you like. There's no commitment involved. It's just a service these firms offer. Jim, super useful. I want to give you the last word here. Before I do, I want to give an apology. Every time I interview you, at least once, if not more, I will call you Dave and not Jim. And the reason for that is we were talking before we turned on the camera here. You're a big cyclist. I used to do triathlons. I spent a lot of time cycling with the first Bianco I knew, and his name was Dave. And so I still have that ingrained in the basal stem of my brain here. So sorry if that slipped out once or twice in this conversation.
Not a problem. There's also a David Bianco who works on Wall Street too, as well. But as the final word is, I do think that investing is cyclical and it's all about expectations, and that's really what I'm trying to get across. The expectation that is 5% a high yield, I don't think it is. I think yields go higher, but the expectation that is the stock market going to, continue to power ahead with these big supersized gains in the index. I don't think they will, but they'll give you a reasonable gain. And the expectation of that there's not going to be drawbacks or setbacks in the stock market because there hasn't been for the last couple of years. Yeah, I think there's going to be, and that we've seen that already. So really, it's really about expectations. And once you've got your expectations right, you can manage that space correctly. And usually when people get themselves in trouble is when they expect something out of markets that they were never going to give them. Big gains, or even people that get out of the market thinking that there's going to be a crash and they're going to lose all their money, and they miss the opportunities as well too. They've both got bad expectations. So you got to get your expectations right.
All right, very well said. Well, Dave, thanks so much. I'm going to let you
Dave
get.
again. You said Dave again.
I just did. There we go. Jim, thanks so much. I'm going to let you get out and enjoy the rest of your Memorial Day with your family. This has been a fantastic discussion. Can't thank you enough. Always great to see you, buddy.
Thank you. Enjoyed the conversation.
Thanks. And everybody else, thanks so much for watching.